during the pandemic. We did one, right, Nate, virtually, but we're back doing virtual, and we're excited to host Nate and have him join us this morning. Nate is the Director of Finance and Administration Ministries for the Missouri Annual Conference. Nate is a practicing attorney who was a former corporate attorney and went to seminary at Emory University's Candler School of Theology, and was a pastor in the Missouri Annual Conference before he joined the staff there. And Nate is, like I said, a great friend of ours, and we're excited to have Nate spend his Friday with us. So a couple logistics for today's webinar. If you have questions during the presentation, please enter them in the Q&A section on, I guess, the bottom of your screen on your taskbar, and Nate will answer them as we go. We are recording the webinar, and it will be posted on our website next week. And just looking ahead from a calendar standpoint, I want to kind of make sure everybody knows this while we have you all. We'll be hosting best practices for the church office coming up in May. So please, we're putting a slide up now. Please alert your folks on your staff and really help us get the word out. We will do these in person, led by a veteran church administrator and member of the foundation board, Diane Wilkinson, also Reverend Donnie Wilkinson's mom. And these workshops will be held from 10 a.m. to noon with lunch following, and they are at no cost, but we do ask that participants register, mainly so we'll have a head count for lunch and know how many lunches to order. We're super excited to be hosting these in person once again for the first time since the pandemic, and we're going to hold them in multiple cities, and you can see the schedule here. We're sending out some information. This is on our website, and we'll send out some follow-up emails as well. We hope Nate's presentation this morning will be beneficial and helpful for making tax season a lot easier for all of you clergy. And without further ado, I will turn it over to Nate.
Yeah, thanks, Chris. Good morning, everybody. Thanks so much for joining today. It is always great to be with Louisiana. It's a funny thing. My heart's sort of in the South. My mother was from Georgia. I did go to Candler School of Theology, and so still have a lot of family down around Atlanta. And then I love being with Louisiana because y'all are also in our jurisdiction. So I feel like you guys are brothers and sisters in the United Methodist Church. So it is always a pleasure to be here. So let me give you a little bit of a roadmap of where we're going. We have a big, long time this morning, longer than what I normally take to do a tax webinar. So we're going to take our time, and I'm going to walk through things pretty carefully. All right, can everybody see that? Perfect. And I will say when screen sharing, again, I'll do my best to watch the chat bar, the bar at the top, and try to keep my my arrow on it so that it remains visible to me. So while I'm talking, feel free to put questions in there. I will get to them as we go. Like I said, I will have a time towards at different intervals throughout the morning where we'll pause and take questions. So the first thing I need to say is simply this. I need to give you a big disclaimer. I am a practicing attorney, but I need to be very clear with you. I am not your attorney. There is no attorney-client privilege created between us. Everything that I'm about to share with you, it's for general information and educational purposes only. It is not legal advice, tax advice, or financial advice. If you need tax advice, legal advice, financial advice, I strongly encourage you to seek out a professional that is licensed in the state of Louisiana. I am not. I am licensed in the state of Missouri. I would just offer that to you as a bit of disclaimer. So as I said, when I set out, I'm going to start with 3 questions. There are 3 questions that you have to both ask and answer. And I should say about halfway through this presentation, I'll give you guys, a 5-10 minute bathroom break to where we can kind of gather ourselves and stretch our legs and things. So, but we're going to start with these 3 questions. And let me be clear, it doesn't matter. You may say, but I hire someone to do my taxes. Great. That's a great idea. I affirm that. In the Missouri Annual Conference, I don't know if Louisiana Foundation does this, but in Missouri, our foundation keeps a list of tax preparers who have done clergy taxes and understand them as kind of a resource. So it's a great idea, and I strongly encourage that. However, let me tell you that at least once or twice every March or April, and sometimes worse, April or May, I get a desperate call from a clergy person whose tax preparer has made a mistake. And they made the mistake because they did not ask or answer these 3 questions that I am about to share with you now. Okay, so the first of those questions, and I think I do this kind of for good humor, you have to do it with the right tone of voice, because clergy are often surprised by what exactly they have to pay. So the question is, clergy pay what? So here is the exact, and let me take another pause and say this. I believe that Louisiana has a state income tax, and it is also possible that places like New Orleans or Baton Rouge have a local income tax. I don't know if they do, but they could. In Missouri, we have Missouri income tax, and St. Louis, Kansas City, and Springfield, Missouri all have municipal income taxes. Now, they're not big, they're small, but you still have to pay them. I am not a Louisiana attorney. I don't have time to delve into every state's income tax laws. So I need you to educate yourself on what the state taxes are that you're going to be required to pay, or any local taxes that you have to pay. And that would include things like in a parish in Louisiana, I'm assuming there is some kind of property or ad valorem tax that is probably in place. I'm not going to talk about any of that today. I'm going to talk about taxes at the federal level. This is what the IRS, what you're going to be working with the IRS on. And clergy pay, first of all, and because every U.S. American pays this, clergy, and quite honestly, every even non-American that's working in the U.S. has to pay U.S. income tax. That is one tax that we're going to talk about today. Income tax is governed by the Internal Revenue Code. There are internal revenue regulations. The regulations, here's how you can understand this. The code is the statute. It is what Congress has adopted. It is, if you're wanting to read some of the code, you can actually get it online. It is chapter 26 of the United States Code. And it is pretty long, to be quite honest. When I was in law school, I took a U.S. income tax course. And back then, I'm old enough that you went to the bookstore to buy your textbooks. And we had a textbook called U.S. Income Tax. And then in addition to that, you had to buy a copy of the U.S. tax code. And here's the thing. It was thick. It was like this. And it was abridged. It was an edited, shrunk down version of the tax code. It was not only abridged, but it was also printed, and it was thick. It was printed on thin paper, like the pages of the Bible. The U.S. tax code is a pretty voluminous document. Chapter 26 of the Internal Revenue Code is quite long. If you were to actually bound it, and like law firms and law libraries do this, if you were to bind it and put it on a bookcase, it would take up about a shelf's worth of space in multiple volumes. It's a longer document. Well, the thing is, and maybe you've heard this before, sometimes Congress says, here's what the statute is. We're adopting this statute, but you know what? We're going to create an agency, and that agency is going to be tasked with interpreting the statute. And in fact, I think you know this, the tax code has an agency that is created. They are our friends at the Internal Revenue Service. The IRS is created by Congress to collect tax, but also to interpret the tax code. And so the IRS will issue regulations. And those regulations are also collected in Chapter 26, but not of the US Code, but of the Code of Federal Regulations. And if you were to take all of Chapter 26 of the Code of Federal Regulations, all the regulations that the IRS has adopted over its history or that are currently in place, and you were to put those on a bookcase, it would take up a whole bookcase worth. It's a long document. But then in addition to that, the IRS also, sometimes people read, especially attorneys, read the tax code, read Chapter 26 of the US Code, and then also read all the regulations interpreting that part of the code, and they're not sure what to do. And so you got to have an attorney to do this, but they can actually ask questions of the IRS. They can request what is called a revenue ruling. And so once the IRS issues a revenue ruling, while it's not quite the same impact as the statute, the tax code, a court looking at it is going to give it very heavy weight in saying, yep, that's what the law is. So you have all these revenue rulings. In addition to that, sometimes even with a revenue ruling, I don't know if you know this, but sometimes people have disputes with the IRS. And actually, Chapter 26 of the US Code creates a whole system of US tax courts. They are within the federal judiciary, and they receive all the tax cases in the first instance. And those tax courts make a decision. But if you don't like it, and they'll write an opinion, and they'll issue that opinion. But if whoever sought the opinion, whoever had the dispute, they don't like the decision, they can appeal that opinion up into the actual federal judiciary, into the US district courts, then up to the US courts of appeal. And if you don't like that, you can actually go to the US Supreme Court. So every year, the Supreme Court actually issues some tax opinions. At every stage, those courts will issue either orders or opinions. And while those opinions are only effective for that case, once you're to the Supreme Court, it's effective for everybody. It's the law of the land. But all of those have very heavy weight and really have the weight of law. That is what the law is once they have made that decision. Well, if you were to take everything, all the revenue rulings, and especially if you were to combine it with everything the IRS puts out in the way of guidance, instructions to taxpayers, if you were to take all the court opinions that affect U.S. tax law, and you were to bound them up, print them on paper, bound them up, and put them on bookcases, it will take up a whole law library of space, a pretty large room's worth of bookcases. And I know that because the law firm where I worked, again, I'm old enough that everything was printed and bound, and we had our own tax law library. It was we had a law library for normal litigation stuff, and then we had a tax law library because the court had a pretty big tax department. The little firm had a pretty big tax department, and it was a large room with all of this stuff bound. And to make it even more complicated, it's all subject to change at any time. So in 2017, just a few years ago, all of a sudden at the end of the year, the 9th hour in December, Congress passed an overhaul of US tax code. Now, I say overhaul. It wasn't quite the overhaul that the party that passed it wanted you to believe it was. There was all sorts of talk of you'll be able to do your taxes on a postcard. Let me tell you, even if you're affiliated with that party, great, but that has not come to fruition. We do our taxes pretty much like we did before 2017, and probably no matter which party has control of Congress and the White House, that's probably the way it's going to be. And I'll talk a little bit about that when we get into it. So I say all this, I give you all this information, actually not to scare you. I give it to explain why the American public feels so intimidated by US tax law and US income tax. It is not somebody anybody enjoys doing. Even tax attorneys will tell you they don't really enjoy doing their taxes. It's not a pleasant thing. I say it all to give you a sense of why people are afraid of the taxes and to give you this assurance. You only need to worry about a very small fraction of it. Most of all of those court decisions, most of the statute, most of the regulations don't have anything to do with you as an individual clergy person in the United Methodist Church. Only a few parts have something to do with you, and I'm here to suggest it's manageable. We can do this, and my hope in doing these webinars, since I've been doing them since probably 2014, my hope is that I demystify US income tax law just a little. It's still going to be complicated. You're still going to hear things that don't make sense, but at the very least, I want it to be demystified for you so that you are less intimidated and can get this done. Now, here's the problem. Part of the problem for clergy. You do not know, and just this is the case for all Americans. You don't just pay US income tax. You also have to pay for Social Security and Medicare. So we're gonna talk about US income tax, but for at least a little bit, especially for clergy, we got to talk about Social Security and Medicare. What is Social Security? It is the pension plan for America. If you work your whole life, you put in 35, 40 years of work, and you have paid into the Social Security system, when you retire, the US government will begin, the Treasury Department will begin to issue you a check through the Social Security Administration, and it doesn't come by mail anymore. It's all electronic. It gets deposited in your account. I liked it better when it came by mail. My grandfather in rural North Georgia, he lived to sit by in his chair and wait for the mailman to bring his Social Security check. What was funny about it was my grandfather, while a blue collar guy, worked his whole life and never spent a dime and would just take his Social Security check and just put it into a CD at the bank because he didn't need to spend it. He didn't need it, but he loved to get it. The government was giving him money, and for the rest of his life, it had only gone the other way. He had only ever given the government money. So that's Social Security. It is, if we pay in, if we're part of Social Security, we will receive a check for the rest of our lives. And if you have a spouse, when you die, your spouse will get a small benefit check when you die. It's not big, but it's a death benefit. So what is Medicare? Well, Medicare is the retiree health plan for America. And you will hear all sorts of things in the press that Social Security and Medicare, they're either inadequate or they're unsustainable. We can't afford them as a country. You hear it both ways. The truth of the matter is there's a kernel of truth in both of those statements. They're not enough. They are hard to sustain as a country. They are expensive. So when you retire and you hit age 65, you will sign up for Medicare, and Medicare will begin picking up part of your medical needs. Now, there's an accompanying plan called Medicaid. Just set that aside. We don't need to get into that level of complexity. But just know Medicare is the retiree health plan for America, and at least the basic parts of it, assuming you've paid in over the course of your working career, it's free. Not all of Medicare is free, but the basic plan is free to you as an American. Well, I just said it though, it's expensive because you're cutting a check to everybody in the country who has put in their time in career, paid in, and you're paying for the medical bills or part of the medical bills for all the retirees in the United States. That is an expensive endeavor, and it takes funding. We have to contribute to it. So in the Louisiana Annual Conference, I know a little bit because I know your treasurer. I know folks in the conference office in Louisiana, and I know that you all have some form of health insurance. And I know that clergy are part of WestPath, part of what we call the pension in the United Methodist Church. And you know what? Those also are expensive and they require funding. And in the United Methodist Church, we ask our clergy and or our churches to make contributions to those plans. Well, Social Security and Medicare are no different. The government asks you to make contributions. And so I got a question about Medicare. I'm not going to cover Medicare today, but generally you have to sign up for Medicare. And I don't want to say in every instance, but in most instances, even if you are not yet retired, even if you're in a group health plan, most of the time, those group health plans want you to enroll in at least Part A, the basic part of Medicare, when you turn 65. But you will need to check with your annual conference and your group health plan to know for sure if you need to sign up for Medicare. But generally, you will sign up as a general rule. So back to funding these plans. So there are a couple of ways that the government talks about funding Social Security and Medicare. I'm going to go to the second one first, the Federal Insurance Contributions Act. Notice what it's called, the Federal Insurance Contributions Act. The contributions paid in through these funding programs fund Social Security, the pension plan, and Medicare, the retiree health plan for America. But that said, typically, we don't talk about contributions when we pay something to the government because we don't like paying into the government. Instead, we talk about taxes. Federal Insurance Contributions Act funding is a Social Security and Medicare tax. And in fact, the Federal Insurance Contributions Act has attached to it a Medicare tax. Okay, I'm going to talk about that in just a minute. There is also a second funding program, and that is called the Self-Employment Contributions Act, SECA. So you have SECA and you have FICA. And these two programs fund Social Security and Medicare with the attached Medicare tax on it. Now, I've given away the answer here on the first slide, but most of America is a participant in the Federal Insurance Contributions Act, in FICA. Most Americans pay FICA. And let me explain how that works. Most of Americans, when they go to work, they work for an employer. And the employer has to actually withhold an amount from the employee's paycheck to pay for FICA, to pay the contribution. And the key amount for FICA that they withhold from an employer's paycheck is 7.65% of the compensation, okay? Fix 7.65% in your mind for FICA. Then the employer has to take another 7.65% that the employer funds, and it matches it to the 7.65% withheld. So the total is 15.3%. And that includes both the Social Security contribution and the Medicare tax. Okay, 15.3%. Note who pays it. The employer pays it. They withhold some of it, they match, and then they fill out a payroll tax return called a 941 that they send in to the IRS. 15.3% of an employee's pay gets that funds Social Security and Medicare. Well, if you're self-employed, if you don't work for an employer, if you are working for yourself, you're responsible for the Self-Employment Contributions Act. You don't have a paycheck to withhold it from. You withhold it from yourself as part of your tax return. And guess what the amount is? It's not 7.65. You have to pay the whole thing. It's 15.3% of your pay. Now, it's a little more complicated than that. There are some deductions that you get, including you get to deduct some from your income tax. We'll talk about all that in a little bit. But generally, you're paying 15.3% of your income for Social Security and Medicare funding. And clergy are self-employed for purposes of Social Security and Medicare and have to pay SECA. I've got some questions here. Let me pause. Let's see. Does that mean? Oh, got it. Yeah, you will have to take all those questions up with your annual conference. It is perfectly legal to be in a group health plan and to be enrolled in Medicare. That is what we have people do in Missouri. They go ahead and enroll at 65, even if they work until they're 72. And we keep paying. They're still in the group health, and we keep paying for, the churches keep paying for their group health. But you will have to talk to your conference in the Louisiana conference to know how that works there. All right. So this is a key concept. Clergy are treated as self-employed and pay self-employment contributions. So the question, clergy pay what? You pay income tax and you pay Self-Employment Contributions Act contributions, 15.3%. So your income tax and SECA are combined. You pay both, but we're going to talk about this. Both get paid when you do your tax return, or we're going to see you probably need to be paying before that, but we'll talk about that. Second question, clergy work for who? Because we're United Methodists, right? And this is complicated. Who do you work for? Well, you might say, I work for the bishop. If you're clergy, especially if you're an elder or a deacon, especially if you're an elder and you said, hey, I'll go wherever I'm sent, it is the bishop, in fact, and the cabinet who tell you where you're going to go within the conference. That's a pretty big part of the employment relationship, to be told what work you're going to be doing and where you're going to be doing it. But then you also, our hiring process is a little complicated in the United Methodist Church, right? Even if you're a licensed pastor, a licensed local pastor, you've got this thing called a district committee, right? A DCOM. You got to deal with them. They get to decide, are we gonna approve you? And then the bishop gives you a license and tells you what church you're going to be appointed to. And if you're an elder, you got both the DCOM, and then you go on to the Board of Ordained Ministry, and you've got them. The Board of Ordained Ministry is like this credentialing agency. It's like they're responsible for hiring people. And while it's a lot more complicated, they can even participate in the firing of people sometimes. And then on top of all that, you go and you get appointed to a local church where you then have a staff parish relations committee or a pastor parish relations committee, and you get paid by the local church. Well, in the eyes of the IRS, that's all they care about. Who pays the check? In the eyes of the IRS, with respect to income tax, you as clergy are an employee of the local church to which you're appointed. Now, if you're appointed to an extension ministry, the extension ministry. So that actually, believe it or not, you may not know this, anybody on conference staff, that's actually technically an extension ministry. I'm an extension ministry on conference staff. My employer is the annual conference itself. But the annual conference is not the employer for individual clergy that are appointed to local churches. In the eyes of the IRS, it's the local church, because that's who pays the bill. Now, you may see the confusion already, right? I just said a few minutes ago that you pay income tax and you pay self-employment contributions. Self-employment. But now I just said, in the eyes of the IRS, you're an employee of the local church where you serve. But that's for income tax. And it brings me to the last question. What is your employment status? And like that, what does that even mean? I don't mean, are you employed? Are you unemployed? Here's what I mean by it. And that this is important. So first of all, you do, as clergy, pay self-employment contributions. And you may ask the question, why do we have to pay self-employment contributions if we're employed by the local church? And actually, it's because Congress made clergy self-employed for purposes of SECA. And you know why that is? This is 100% the truth. Churches don't know squat about finance and administration. They are horrible at it. When these laws were passed, when SECA and FICA were adopted, we're talking 1950s, 1960s, when they were conceiving of this funding program, how many people worked in a local church? And the answer was generally one. You didn't even usually have a church secretary yet back then. You had a pastor appointed or that was hired, depending on the tradition, by the local church. And Congress looked out and said, gosh, FICA, 7.65% withholding, 7.65% match, paying at least a quarterly payroll tax return. Churches will never figure this out. Here's the solution. Make it simple. The clergy are responsible for self-employment contributions, and churches don't withhold FICA for pastors. We'll come back to that in a minute, and I'll talk a lot about that this afternoon for our local church administrators. However, most people who are self-employed, who are paying self-employment contributions, they have this special status. They are that of an independent contractor. And an independent contractor is, the best example I can give you is the lawn guy, the guy who cuts your grass. He brings his mower. You say, yep, I want the lawn cut once a month at the church. If you're lucky, the lawn guy will do it on Friday. In my experience, serving a local church, the lawn guy always did it on Monday so that it looked horrible by the time Sunday rolled around, or it would rain and he wouldn't be able to do it at all. But you get the idea. You hire the lawn guy, he cuts the grass, you pay him whatever it is, $200 a time, whatever his fee is. He brings his own equipment. He decides when to cut the grass, decides when he needs it. He supervises his own work. He's an independent contractor. He works for himself. The church pays him, say, $2,000, $3,000 over the course of a year, maybe less, but anything over $600. And the church has to report to the lawn guy how much they paid him. And they do that on a form called a 1099. He's self-employed. He pays self-employment contributions on everything the church pays him. So he gets a 1099. Well, clergy are self-employed for purposes of Social Security and Medicare. They pay SECA. So that must mean clergy get a 1099, right? And that's wrong. Clergy don't get a 1099. You're not an independent contractor, even though you pay self-employment contributions. And this, I would say, is one of the most common mistakes that tax preparers make. Also local churches, especially small local churches, because the truth of the matter is a 1099 is a simple form. It is easy to fill out. It is easy to give the pastor. Templates are available online. You can fill them out. Even a very small church where, the treasurer, Mildred, keeps the checkbook at home, writes out a physical check out of the church's account to pay the pastor. They want to give a 1099 because it's easy. The problem with that is the IRS, GCFA, our General Counsel on Finance and Administration back in I think it was the late 80s, early 90s, actually asked the IRS. The IRS said, no, pastors are employees. They have to get a W-2. GCFA challenged it in tax court in a very famous decision called the Weber case, Weber versus the tax commissioner at the time. The United Methodist Church, GCFA, we lost. The court said, no, the IRS wants a W-2. They get a W-2. So this set up this strange situation where despite paying SECA, Clergy have been declared by U.S. courts and by the IRS to be employees of their local church for income tax purposes. And that means clergy get a W-2. They are not independent contractors. They're employees of the local church. Okay, I'm going to walk you through a W-2 to see what it looks like. And let me say this, if you are a pastor and you are getting a 1099 from your local church, you need to have a conversation, not with me. You need to have a conversation with your conference treasurer or your district superintendent, probably the treasurer first. The district superintendent may need to help you. But in my experience, the treasurer will know the rules better than the DS, and you have a good treasurer in Louisiana that I know well. You need to have a conversation because you're not getting proper tax reporting. And it is every time I do one of these workshops, whether it's for Westpath or another conference and even in Missouri, I will have somebody come up to me on a break and say, I'm getting a 1099. What do I do? And the answer is you need to go to your conference treasurer. It may be fine. You may not want to correct it in the past. You may want to just get it right for the future. If the IRS hasn't screamed about it yet, they're probably not going to, but you don't want to take that chance going forward. You got to get them reporting correctly on a W-2. And here is, that said, a W-2 for local churches or for clergy, whether you're licensed, commissioned, ordained, it doesn't matter. As long as you are clergy as defined by the Book of Discipline. Now, if you're lay supply, you're going to get a they do need to withhold FICA, and you're going to have a normal W-2. But the W-2 for clergy actually looks different than the W-2 for most Americans. And I'm going to show you why. The form's the same, but they're filled out a little differently. So what you have in front of you on your screen is a W-2 from 2022. And I'm hoping you can see my cursor. So here is the employer. And we just, this is a template that my staff pulled for me from the internet. They're in Pennsylvania. If you want to change the P to an L and make it anywhere in Louisiana, you can. This is the employer's employer identification number. It's like the employer's social security number. Here's the employee's social security number. Okay. And then we're going to come over here and you're going to see these boxes. And the key boxes are 1 through 6. Got that? I'll talk about some of these down here in a minute. All right. First of all, you have wages. That's what the church has paid you. Now, we're going to see in a little bit, it's going to be everything the church pays you except for housing allowance. That won't appear in here. Neither will anything they withheld to pay for health insurance. Neither will anything they withheld is the key, withheld from your paycheck to contribute to PIP if you did an after-tax, a before-tax contribution. So this is everything you made that is taxable, okay? And we're going to talk about the key concept here will be gross income from this employer. We'll talk about that in a little bit, okay? That goes in box 1. I'm going to come back to box 2 in just a minute. Box 3 is the amount that is taxable for FICA for a normal secular employer and employee, a non-clergy employer. Some of what they make is taxable under FICA. Okay, and some of what they make is taxable on the Medicare tax. And you'll notice they're different because actually, and this is true for clergy too, which we'll talk about, more is taxable under SECA and FICA for Social Security and Medicare than is taxable under U.S. income tax. Okay, so most people have an amount in boxes 1, 3, and 5. You come over here now, we're going to come back to 2. Let's go to 4. This is the amount withheld for FICA that's related to Social Security. This was that 7.65% that got withheld. It's actually not 7.65%. These two combined are 7.65%, boxes 4 and 5. Whoop, I skipped ahead. So these are what are withheld to pay for FICA. It's the amount you've already paid in for FICA, okay? Now, box 2, for most Americans, The employer is also obligated to obtain a form called a W-4. And the W-4 has an estimate of what the employee is going to owe in U.S. income tax, and it has the employer withhold it from the paycheck, and that withholding gets reported here. And you get credit for it when you fill out your 1040. Okay. This is a W-2 for most Americans. Come down here. Here's the state income tax stuff. That this would be state, and even though down here would be local stuff. Okay. This is for most Americans. Got that? Let me show you a clergy's W-2. This, it still says big company because I couldn't get the template to change it to the big church. It should say big church. A church also has an employer ID number, still the Social Security number, still the amount that is taxable comes over here. And we're going to talk about it. It won't include housing. It won't include any amount withheld for health insurance. It won't include any amount withheld for pre-tax contributions to PIP. Okay. I'll come back to box 2 in a minute. Box 3, 4, 5, and 6 all should be blank. Why? Because you don't pay FICA. You're exempt from FICA. You pay SECA, and you will have to calculate that on your 1040, and really you need to think about it in advance. We'll talk about that, okay? So this is a clergy person's. Now let me come back to box 2. You see an amount here. Now, technically, if you don't do anything and your church doesn't do anything, they don't have, if you're the only employee of your local church as the pastor, they don't have, you don't need to do a W-4. You're exempt from it. You're exempt from all withholdings. They don't have to withhold income tax on you, and you don't have to have it withheld. However, if you're on a church with a staff and the church is already filling out a 941, it is entirely legal for you to estimate your income tax that you're going to owe plus what you'd owe for SECA and have that amount withheld from your paycheck and paid with the 941 that for all the lay staff. What I call it a voluntary withholding. And you do that by filling out a W-4, even though you're not obligated to fill out a W-4. And you write exempt where it tells you to write exempt. And then there's this box that says any additional amounts you'd like withheld. You fill that out with your total estimate, and your church will withhold it from the paycheck, and you will get credit against your income tax and your self-employment contributions when you do your tax return in April. And we'll talk about this a little later. That is critically important. You don't have to do it, but if you don't, you do have to do what are called quarterly estimated payments in advance. We'll come back to that a little later, okay? The last thing I'd point out on the W-2 before I get to the questions is down here in 12A and in 13. In the United Methodist Church, if you especially it depends on your conference what they elected with respect to CRSP, the United Methodist Pension, but it is possible you're going to have an X in box 13, and you're very likely, because if you contribute to PIP, you have a health plan that the church contributes to, you're going to have letter codes in box 12A, B, C, and amounts here. Don't be intimidated by those. If you're using tax software or your tax preparer is doing your taxes, they will know what to do with them, but those amounts are appropriate for a United Methodist clergy person's W-2. And you might have something here in box 14. Specifically, you might have a little box that is probably in all caps, housing with an amount. If you get a housing allowance or you get money paid towards your utilities, the local church, we'll see this, it's not taxable. It doesn't go up here in box 1, but it's helpful if the local church tells you what it is down here in box 14. It's a miscellaneous box. They don't have to do that, but it can be helpful to you because, as we're going to see, you don't pay income tax on your housing, but you do pay self-employment contributions self-employment taxes on your housing. And so it's helpful if you know the amount. Okay, let's see the questions here. The estimate in theory, so the question is, the estimate would in theory maximum need to be that 15.3% for the W-4. And actually, no, it's more complicated than that, because the estimate needs to include both your U.S. income tax, which we're going to see is not based on everything you make. It's based on a portion of what you make, plus the 15.3%. Now, and as I said, even self-employment contributions, it's more complicated too, because it's not quite everything you make. There are some deductions that are related to it. Here's my best advice for you. If you figure out what you owe, you can use 15% with a little bit more tacked on for your U.S. income tax. Most people are looking at 18 to 25% really to cover everything. That's going to be probably the top end of that be probably way more than you need to do. The bottom end of it may not be quite enough, but once you figure out what you owe in a previous year as a clergy person, then you know about how much to withhold for the next year. Even if you get a little raise, if you have a little pay cut, you're going to have a better sense. Use that amount that you had to pay the previous year to calculate what you ought to have withheld for, say, for 23. So this is, I tell folks, I get asked to do this presentation often in March and April, and in February. The truth is that's probably too late. You need to be thinking about your 2024 returns right now. Thinking about what did I owe for 22 that I'm paying here in 23, estimating for 24 based on that amount, okay? And then the next question is, do we pay income and SECA on utilities? You do not pay income tax on utilities, but you will pay SECA on utilities, okay? We're going to talk a lot about utilities a little later in the presentation. Okay, make sure I got all those, yeah. All right. Let me pause there and just see, I'm going to put you out as actually, I'm going to stop the share for a minute, put you out as a panel so I can see. You can use your hand if you want to raise your hand. You can put it in the chat. Any other questions? Does that all kind of make sense? Don't see any questions. All right. Go back. All right. I am going to now dive in and give you an introduction to income tax basics. So you have your 3 questions and you have the answers, and you need to share those with your preparer. If you do your own with software, you got to keep them in mind. You need to pay income tax and self-employment contributions. You work, you're an employee of the local church. And so, and you're an employee, even though you pay self-employment, you're an employee. So you need to get a W-2 and not a 1099. And your W-2 is going to look a little different because you pay self-employment contributions. It's going to look a little different than a normal person. No, I shouldn't say normal person, a secular employee's W-2, because you're not paying FICA. Okay. That is the gist of the first part of what I've been talking about. So let's dive into U.S. income tax basics. Okay. So we are setting aside for now self-employment contributions. We'll come back to it. But for now, don't worry about Medicare and Social Security. Don't worry about SECA. We are just going to talk about U.S. income tax for a little bit. Okay. U.S. income tax is not based on everything you make. I think most people think when they hear the language of tax brackets, they may even have a sense of what those brackets are. There's a 10% bracket, a 12% bracket. Most people think, okay, well, if I'm in the 15% tax bracket, that means I pay 15% of my income. But that's not correct. It is a lot more complicated than that. But But the beauty is, I say this in these presentations, it's not as complicated as you think it is. And in some ways, while our tax system is not entirely fair, it is, however, a really elegant system. And I would say this, it strives for fairness. It doesn't get there. It's not quite there. And, sometimes Congress makes changes to it that either feel unfair or that really are unfair. But it is an elegant system that strives to be fair for the American people. Instead, U.S. income tax is based on a concept called taxable income. And I'm going to walk you through how you get to taxable income. And then I'm going to continue on and talk you through how you get to the amount you actually owe the U.S. government. Okay. So, and it is all captured in one. I used to have like a dozen slides to do this. My staff has helped me. My communications office has helped me. I have distilled the entire introduction to U.S. income tax into this single slide. And I'm gonna walk you through it. And then I'm gonna stop sharing and I'm gonna bring up a 1040 so we can walk through that together and you can see. Okay. So U.S. income tax begins with another concept called gross income. And gross income is not quite, but almost everything you make in a year, regardless of its source. So first of all, what is not included in gross income? What income do you get that you don't have to report to the IRS at all? Well, two big things for clergy especially. Number one, gifts. Gifts are not gross income, okay? However, we need to talk about gifts. What is a gift? A few years ago, there was a very famous, and it sounds like now it may be coming back up. The concept may come back up given yesterday's news. A few years ago, there was a phrase, a Latin phrase that was in common use. And the phrase is a quid pro quo. It literally means something you receive in return, okay, or something you receive in exchange. A quid pro quo means there is no gift. If you got something in return for something else, if there's an exchange, it's not a gift. So let's take it to the easiest level. You have an aunt that loves you. And for your birthday, the aunt sends you $100. That $100 is from a family member because the family member loves you. And that's it. That's a gift. However, the same aunt, you go to that aunt's house and you do a whole bunch of work for the aunt around the house. And it's not 100, the aunt gives you $1,000 in exchange for the work you did. That's a quid pro quo. You did work and got paid for it. That's gross income. Now let's take it into the world of the church. This happened to me exactly one time when I was in a local church. One time I had a very sweet elderly woman who adored me. I visited her when she was in the hospital. I went to her house and spent time with her. She was wonderful, sweet. One Christmas Eve, as she was walking out of the sanctuary, she put into my hand an envelope and said, "Open that later when you're by yourself." And I said, "Thank you, that is very kind." I thought it was just a card, okay? When I got to my office, I wasn't by myself. I had a staff member with me, two staff members with me actually, and I opened it and inside was $500. That was a gift from a person who really cared for me. That's a gift. It's from an individual There's nothing really of substance that it's in exchange for. I guess you could say I went to visit her, but that it's really because she liked me. She gave me $500. That's a gift. However, and this is a key concept for you today, write this down. Your employer can never give you a gift because there's always a quid pro quo. And that is the work you're doing for your employer. Your employer as clergy is the local church. So if the local church says, hey, for Christmas this year, we're giving you $100 extra in your paycheck, that's great. That $100 needs to go in on your W-2 in box 1. It's gross income. There's a quid pro quo, the work you did for the church. They're just giving you extra pay. Say, wait. What about a love offering? They took up a love offering and they just gave me cash from the plate. Sorry, even if it's cash from the plate, they shouldn't do that, first of all. That is a really bad financial practice. There's no accountability in it. But if they do it, it was a collection of the congregation that was given to you that's from your employer. They ought to count the amount and add it to your W-2. You say, wait, what about honorariums I get for funerals and weddings? You are doing a service for whoever gave you that honorarium, either the funeral or the wedding. In my experience, the honorarium for weddings is better, it's more, but not worth it. The honorarium for funerals is smaller, but much easier because nobody complains about a funeral. But either way, you've done a service. That's a quid pro quo. And in fact, funeral homes have discovered this because some of them got burned by the IRS, who figured out that families were running money through the funeral home to the clergy person. No reporting was done. If that happens, you're a contractor of the funeral home. They have to give you a 1099. And today, the vast majority of funeral homes are, in fact, you do a funeral or two for them. Especially if you do several and you're over $600, that funeral home is giving you a 1099. It's gross income. You're supposed to report it. Okay. Gifts are not taxable. They're not gross income. But sometimes in the church world, we get confused as to what's a gift. You have to ask yourself the question, is this an individual giving this to me because they care about me? Or have I done something in return for it? If you've done something in return for it, the safe option is always add it to your 1040 under miscellaneous income and pay taxes on it. Okay. The other thing that is not gross income for clergy, this is key, and we're going to talk a lot about it at the end today, is housing. What you get paid in housing, whether it's a utilities, money paid to the utility company on your behalf, or money given to you to pay the utility company, or if you get a housing allowance, or, and this is really hard for clergy, you have value in your parsonage. If you have a parsonage, that's value to you. It's something called imputed income, but because of one section of the tax code, it doesn't go in your W-2. It's not taxable for income tax. But all of those things we're going to see a little later are subject to self-employment contributions. And that'll hurt because you don't, especially if you have a parsonage, you don't see the value of that parsonage in a paycheck. You got to pay for it out of your funds that you do get. So those things are out, but almost everything else is in as gross income. So some examples that you might have. First of all, the money you get from the church. If you had a house before you became a pastor and now you still own it and you rent it to someone, rent is gross income. Okay. If you did like me and wrote a book and you get a very, very paltry royalty from Abingdon Press, from Cokesbury and the United Methodist Publishing House, and it's paltry, let me tell you, writing a book is no way to fund your retirement. Whatever you get though, they're going to send you a 1099 because royalties are gross income. All of those, the funeral honorariums, the wedding honorariums, gross income. Even if you get illegal income, or God forbid you go to a casino and you win big at the casino, income from gambling is gross income. So generally, the rule is it is included unless it's specifically excluded. And typically for clergy, the only things out are gifts and housing. Illegal income is a real thing. It is why Al Capone went to jail. He got all this income from his bootleg liquor operations. They did not get him on bootlegging liquor. They got him on not reporting the income to the IRS. His accountant flipped on him, and that's why he went to jail. So that's gross income. It's everything you make unless it's been excluded by the tax code, like housing and gifts. Once you've got gross income, once it's all together, you then get to take some things out. You get to subtract some stuff. And when we subtract things from gross income on our tax returns, it's called a deduction. And you're going to see two kinds of deductions. We're going to call one above the line deductions. Don't worry about the line just yet. It's just a phrase because of where they fall on the Form 1040. Of the key concept, above the line deductions are available to everyone. Okay? Above the line deductions are available to everyone. And there is a big one for some, but not all clergy, and that's student loan interest. If you paid interest on a student loan that is qualifying, you get to deduct that interest as an above the line deduction. It comes out of gross income. There are some other things that come out as well. Some credits for your dependent, or some things for your dependents. You get a deduction for some of your dependents. But we'll see some of that on the 1040. Once you clear out all those things, you are left with a new concept called adjusted gross income. You take adjusted gross income, and that's a concept the IRS uses for a lot of things. But your adjusted gross income, you then get to reduce it even further. Now you have a couple of choices. You either take what are called the standard deductions, or you take itemized deductions. And you're going to combine your itemized deductions, and you're going to look at the standard deduction, and you're going to ask which one is more, and you get to deduct the bigger of the two. It used to be when I did these workshops, I spent a lot of time going through itemized deductions because most clergy ended up itemizing. It was better for them to itemize. And I'll say why in a minute. However, since 2018, it's not quite to the point that I can eliminate talking about those itemized deductions, but I got everything into this slide. Because now most clergy, the vast majority of clergy, take a standard deduction. And here's why. In 2017, as part of the tax overhaul, Congress almost doubled the standard deduction. And in fairness to them, that simplified things. They were trying to get to a simpler tax system. That simplified it for most people. Most people no longer have to worry about itemizing deductions, adding them all up, figuring out floors and ceilings and things like that. Most people, including you, will probably take the standard deduction. And the standard deduction today is pretty sizable, and it gets adjusted every year based on inflation. And we've had some inflation, so it's going up pretty significantly. Now, that said, you as clergy, especially if you own your own home and you are particularly generous, especially if you're single, you might still be itemizing, because itemized deductions, I want to talk about three. Number one is the charitable contribution deduction. This used to be why most clergy itemized, because when the standard deduction was only, like for a married couple, was only $12,000, most clergy, if they tithed on their income, and especially if they had a spouse that worked, they gave that much to their local church. I mean, I worked in a mid-sized church but had a spouse that worked, and we gave $10,000 to the church every year. It put us in the top 3 givers of the church, right? We've all had that experience. But just because we tithe, we weren't like particularly well-to-do or generous. We just tithed on our income. Well, and then in addition to that, we owned our own home that allowed us, the next one I'll talk about, and the combination always exceeded the standard deduction. The charitable contribution is still a valid itemized deduction. And if you tithe, and especially if you are in a larger church, you make a large salary, and you have a spouse that does very well, and you tithe on it, you might still be approaching, and especially if you're single, and you are paid well. But that's the charitable contribution deduction is an itemized deduction. You only take it if the total of all your itemized deductions exceeds the standard. The second itemized deduction that might affect you is the home mortgage interest deduction. If you own your own home and you have to live in it, if you own your own home and live in it, you can't live in a parsonage. If you live in a parsonage and you own a home, it becomes investment property, not a home. But if you own your own home, you live in it, and you have a mortgage on it, or in some states, it's called a deed of trust. If you have a loan on that home, secured by that home, and you paid interest on that loan, the interest you paid over the course of the year is deductible as an itemized deduction. So you get $3,000 to $4,000 in interest you pay, plus you've given generously to your church, you might still be itemizing. It's just a lot less likely because now the standard deduction is so high. The last one I'll mention, I mentioned it, but it's beginning to go away. It's being phased out. It's a lot harder to take than it used to be, is the medical expense deduction. You get a deduction for medical expenses out of pocket, not that an insurance company paid on your behalf, that you had to pay to a medical provider. I don't want to get into the details. You'd have to talk to a tax professional about whether your premiums that you have to pay can count. But generally, if you have medical expenses, however, it's always been a little hard to take because it has to exceed 10% of your adjusted gross income. And that is often a high threshold. Not all. I mean, sometimes clergy hit it and you can take it. Those 3 are generally the 3 that clergy end up looking at, especially if they've had a surgery or a family member had a surgery, they had something like that. But the key is you add your itemized deductions up, and only if they exceed the standard do you get to take them. If the standard is more, you ignore those itemized deductions, you take the standard deduction. When you subtract the itemized or the standard from adjusted gross income, you are left with the concept of taxable income. And that's the key concept. This is the amount on which you will pay U.S. income taxes. But it's not as simple as just saying, well, I'm in the 15% bracket because of my taxable income, therefore I pay 15%. That's not how it works. Instead, you have to look at the brackets that begin at 10%. And the 10% bracket covers a certain portion of your income. You pay 10% on that portion. The next bracket is 12%, and it covers the next portion of your income. You pay 12% on that portion, only that portion. So then if you cap out at the 12, you take that 12% amount on that portion and the 10% on the first portion, you add those 2 together, and that's the tax. That's your U.S. income tax that you owe. But unfortunately, you're still not finished with your income taxes, because now you have to take tax credits. And this is a good thing, because you have the amount of tax you owe, and then you reduce it by credits. The first credit that I want to talk about may not be available to everybody. If you have a child that is 16 or less, you get a child tax credit. But let me say, I need to skip ahead. I talked through these slides. The child tax credit They have to be under 17 for the whole year. If your child turns 17 in December, sorry, you're out. You don't get the child tax credit. 2022 is the last year I get to take the child tax credit. I have a 16-year-old. She turned 17 this June, and I'm out for 23. Now, back last year, you may have heard a lot about this. Back in COVID, in 2021, the child tax credit got increased by $1,000 to $3,000. And it actually got paid in advance. They wrote you a check if you had a child under 17. They wrote you a check and paid it out on a quarterly basis to you. You got a check in the mail, or if you paid, if the IRS had your bank information from your return, they dropped it into your account. And that was well and good, except then when you did your return, you didn't get to take it a second time. It didn't reduce what you owed on your taxes. So some people opted out so they could still do it on their return. But all of that is now in the past. None of that applies anymore. I guess you might have a leftover. You can check it on a portal on the IRS website. But generally it's all over. You got paid for that 21 tax, that extra credit. It's gone. We're back to $2,000 and it's not being paid in advance anymore. You will get to take it when you do your return in here this week in April, if you haven't already done it. That $2,000 just gets subtracted from the tax you owe. It reduces it directly, dollar for dollar. You have 2 kids under 17, you get $4,000. Okay, so on and so forth. But key, if they turn 17, you lose it. Okay. Another one that affects some clergy is it's called the lifetime learning credit. It's not quite as nice as the child tax credit, but it's still pretty good. It's a maximum of $2,000. And if your tax is already at 0, you don't get to take any more. If your taxes, if you don't owe any U.S. income tax and the child tax, you get to still take that child tax credit. They'll still send you a $2,000 check. This one, if you've already reduced your tax liability to 0 with other credits or with just not owing very much, you don't get to take it anymore. But if you still owe tax and you have expenses paid to a professional degree program, that includes an MDiv, it includes a DMin, it is for the improvement of your job, for your work skills. And it is to a certified institution. Our seminaries and our Methodist universities are almost always certified by the IRS. You get to take the lifetime learning credit. And here's the even more beautiful. If you have a child in college, you get to take it for dependents. If they are still your dependent, if they're on their own and they're not on your tax return anymore, you don't get to take it. But if they're a dependent and you're paying, you're still putting them on your returns, you get to take this even for their tuition. It has to be paid out of your pocket, but it can be borrowed. It just can't be scholarshiped, right? So you get a scholarship, sorry, you didn't pay anything. Okay. You get 20% of the first $10,000 of expenses you pay. That's a $2,000 credit. And most of the time, your university, your seminary will send you a tax form that shows how much you have paid in tuition and qualified expenses. And that's what you will use to do your taxes to take this credit. Okay. It has to be related to this education, to professional education for you. And it has to be part of a degree program. It can't be continuing ed stuff. Okay. The last credit I want to talk about, I don't have a slide for because I don't think of it as a credit, but the IRS does. The credit is what you have already paid. And this takes me back to the W-2 that we've already talked about. Remember, I talked about how you as clergy can voluntarily withhold an amount, and it will cover both your income tax. It will credit against your income tax and your Social Security and Medicare tax. When you finish your 1040, you're going to have a total amount, and that total amount is both U.S. income tax and self-employment contributions. We'll see why when we look at the 1040. It's everything. And the amount you've already had withheld and paid to the IRS credits against that total. And the other option, if you don't have a voluntary withholding, is to quarterly pay in advance through estimated payments on a form called a 1040-ES. Okay? You have to do one or the other. You have to pay quarterly, or you have to do a voluntary withholding with your local church's payroll taxes. And here's why. The government is like a local church. We all know this as pastors. In the local church, times are really good financially in December and January. Why? Because everybody's generous at Christmas. It's when we have, even in the annual conference office, we get most of our income in December. However, the expenses go all year long. And the worst months in the local church, as in the annual conference, are July and August, because everybody goes on vacation, and our people, as wonderful as they are, don't usually think to write their check while they're gone. They might make it up later in the year, but in July and August, you just get less. And in some churches, that creates a cash flow problem, right? You get expenses in July and August that you're worried about making because you don't have the income that you had in December. It's been spent already. The government's the same way. It can't fund itself all year long. It has to go, has to pay. We have to pay as we go, or the government doesn't have enough cash. It gets a cash flow problem. And so the law, the tax code actually requires you to pay your taxes in advance as you go along. For most people, that's done through withholdings, but clergy are exempted from withholdings unless you do voluntary withholdings. If you don't do voluntary withholdings, you are obligated to pay estimated payments. And here's the real kicker. If you get to your 1040, your tax return on April 14th, and you owe more than $1,000, you broke the law and you owe a penalty. It's not a bad penalty. It's not 50%. It's like, I think 3 to 7%. It's small, but it's still extra money you got to pay. And you already have to write a check for more than $1,000. Clergy notoriously get into this because, especially their first year or two in ministry, they don't realize that they're obligated to do the estimated payments or the voluntary withholding, and they don't pay anything. And they go along and they get all this income, they've got this housing income, and then they get to their return, and they don't owe a little, they owe this catastrophic amount. I know clergy who got in that situation and they've had to work out payment plans with the IRS. And that catastrophic amount includes penalties and some interest. It is not a good place to be. Make sure you are estimating, and a tax professional would do this for you, even if you are new to ministry. Estimate what you're going to have to pay for the next year and make sure it's being withheld from your paycheck, or that you're paying quarterly, and the quarterly payments get paid on January 15th, April 15th, June 15th, and September 15th. Those are the dates, including, April 15th. So here's what can happen. You could owe an estimated payment for 24 and have to pay an extra amount for 22 that we just finished. You see how that, for your 23 return. And both checks would be due and payable to the IRS on April 15th. I've been there. It's a rough place to be. So you got to plan for it. You got to pay quarterly or do those withholdings in order to make sure you don't owe too much when you do your tax return. Okay. I am going to pause there and see if and I'm going to stop sharing my screen. If I can find it. Actually, I'm going to do a new share. I'll pull up this. Okay. But let me, let's see. Any questions? You can raise your hand. You can put it in the chat. Is all this making sense to everybody? Okay. So let's look. This is a 1040. And once I go through this, I'll give you guys a break so you can stretch your legs and use the restroom. Okay. This is the 1040. This is the applicable form for your taxes. And this is actually the 2022. I pulled this from the IRS this morning. Okay. So I'm going to walk through it with you. And the first thing is and let me say this, a tax preparer, you'll see this form, but a tax preparer will fill it out for you. If you use software, the software, all of them, TurboTax, H&R Block, whatever you use, it has an algorithm, but it asks all these questions. You're going to be answering these questions in order to fill out this form. And here's what I would say. Remember, I said, like, back in 2017, when one of the parties got tax reform pushed through Congress, and the president was of the same party and signed that law, the big headline was, you'll be able to do your taxes on a postcard. Now, some of actually that law, whether I like that party or not, it doesn't matter. Some of that law actually was a good thing. Some of it I didn't like, and it actually hurt United Methodist clergy. We'll talk about that too. But generally, they talked about how it simplified things. And I gave one example of that simplification in the increase of the standard deduction, which meant most people no longer itemize, which was complicated. However, this is the 1040. It is not on a postcard. It is a 2-page form that if you pull the official version from the post office, which you can still do, but nobody does, it is a front and back. Okay. The first thing is your filing status, and you've got some options here, and I can talk about a couple of these. If you're not married, if you're single, you do single. Most people, if you're married and your spouse, especially if your spouse works, you are going to be married filing jointly. Okay. If you have certain situations, if you're in a situation that, especially if you're in the midst of separation or divorce, or there are sometimes, even if you're not, that you can take this status called married filing separately, you need a professional's opinion around that, not mine. And if you actually have, either if you're not married or if your spouse is dependent upon you, it may make sense, and you have kids especially, you may qualify for a special status called head of household. What it does is, even if you're single, it gets you a little bit better standard deduction than if you're single. It improves your tax lot a little bit, okay? But most people, the vast majority of people, you're either single or you're married filing jointly, one or the other, and you pick which one, okay? And it's one of the first questions that TurboTax or H&R Block will ask you. Are you married or are you single? Okay. Then the rest of this is pretty self-explanatory up here. You know, it's pretty basic information. You can decide whether or not you want to contribute to the presidential election campaign, which gets divided between the two major parties for the presidential election. There's this question about digital assets. You know, this is actually a fairly new question. Again, let a professional help you with that, but generally the answer there is going to be no. You come down here. Now, there's where we get to, already you see standard deduction. Are you going to qualify, and what standard deduction are you going to qualify to take? So the question is, can someone claim you as a dependent? For our clergy, the answer will invariably be no. Can someone claim your spouse as a dependent? And again, the answer is almost no, and you don't check those. And here is one: the spouse itemizes on a separate return, or you were a dual status alien where you're married to someone from another country. But most of the time it doesn't apply to you. That, again, you need a tax professional if you think that may apply. There's some general questions. You actually get a benefit if you are legally blind. There are some, these relate to Social Security and Medicare benefits if depending on how old you are. Okay. Then you come down if you have kids or you have other forms of dependence. It may not be a child, but it's usually a child. You give their name, their number, their relation to you, and a child, especially a child that's, if they're in college under 25, any child under 18, they're going to generally be a dependent. You put their relationship, and if in fact they're under 17, if they're 16 or less, you get the child tax credit for them. And then you get a credit for other dependents here. Again, the TurboTax and H&R tax software will do this for you, as will a tax preparer. However, once you're out of this, now we're into what most people find the scary part, which are the numbers. Okay. So first, remember I said you begin with gross income, and you see right here, income. All of these lines right here to right here, this line to 1H, 1I, these are all income lines. Do you get any of this income? And you, as clergy, will have an amount that goes in 1A. It is generally going to be box of your W-2 plus any other income that you get from a spouse's W-2, or if you have two jobs, your other W-2. Okay. There are other forms of income you might get. You total it here. This is really just a break. This is still all income. You total that amount, these lines here, and now you get to interest income. Do you hold investments? Do you get interest from a bank? Are you getting distributions from an IRA that are taxable? Sometimes they're not, but sometimes they are taxable. And all of that goes here, and then the taxable portion of it goes here. You get, again, you may have other investments, capital gain if you sold investments. All of this, though, gets you to total income. Now, the one thing that's not here in this line 9, that line 9 does not include housing. It does not include gifts. Doesn't even appear on your tax form. It's not gross income. But line 9 is generally your gross income in the eyes of the IRS. And then you get to take the adjustments. Those adjustments, you got to pull up a separate schedule for them, but this is where you're going to have student loan interest. These are I said above the line deductions. What line are they above? Line 11. They're above line 11. You get to take them. They're all on Schedule 1, which is a separate form. That's where you take right here, or where you take the above the line deductions. You subtract 10 from 9, and now you have adjusted gross income. Remember, we walked through that? Now you are to the point where you either take the standard deduction or you're itemized. If you itemize, you use another schedule, another form called Schedule A, where you add them all up. You take the bigger amount and you put it in box 12, and you subtract 12 from 11. And there's a few more potential deductions you could get. But once you do that, you are now down to taxable income. The taxable income is you then apply the tax to it. And now you apply your credits. Child tax credit we talked about. There are a few others that you may get. If you pay self-employment tax, you get a little credit for it, believe it or not. You get to take some, it's not all punishment to you to take the self-employment tax. And you have your total tax you owe added up right here in box 24. Now the payments you've already made, the credit for the payment, the federal income tax you had voluntarily withheld on your W-2 goes here. Anything that you paid that you had withheld on a Form 1099, which is very rare, but it can happen, it goes there. All of that, there are several other payments that you could have made, but once you get all those payments, you subtract the payments from the total tax, and ultimately you either have a refund and it goes here, or an amount you owe that goes in box 37. It is okay to have an amount that you owe in box 37, especially if it's under $1,000. And really, what I would say is you want to have enough withheld or pay enough in estimated payments to get yourself to where maybe you owe just a few dollars, or maybe you get a tiny refund. You do not want either a big amount owed, you really don't want that, but you also don't want a big refund either. You may think, wait, why don't you want a big refund? Because remember, the majority of the refund is made up by an overpayment that you made. And you would have made that overpayment by either through those withholdings all along through the course of the year or through quarterly payments that you made. And what it means is you've given the government your money that you didn't owe it. They don't pay interest on it. It's an interest-free loan to the government. And in my experience, you usually don't get a refund back. If you file your taxes in March or April, your refund often doesn't come until May, June, or even July. And if something happens, the government shuts down or whatever it is, those things can get delayed into August, September, even October before you get it back. And that could have been paid more than a year before you made the payment to the government that you didn't actually owe. So the goal is to have either a small refund or in a small amount owed that you can easily afford. That's the goal to doing your taxes. Okay. I'm going to stop sharing my screen right now, and I'm going to pause to see if there are any questions. All right. I don't see any. How about we do this? I have 10:17. How about we take until 10:30 and come back at 10:30? Would that work? I see no objections. So I'm going to pause here. I'm going to mute myself and actually take myself off. I will be back. I'm not going to turn Zoom off. I'll be back at 10:30 and we'll pick up from there. All right, actually, I gave you all a little bit more time than we had planned, but I think we've got the flexibility here. All right, so let me just see real quick if there are any questions that came up on the break. Again, you can put it in chat, or actually, maybe there is one in chat. Let's see. All right, let me pull this up to where I can read it a little bit better. If my W-2 box one is $10,000, my wife box W-2 box one is 10,000. Should I input 20,000 on form 1040 income line 1, even if I file self-employment form and pay the 15? Yeah. So be clear here. The 1040 is primarily a U.S. income tax form. Now let me pull it back up and go back to sharing my screen with it. Let's see, share screen. All right, so these amounts in this up here in line 1, these are really primarily focused on U.S. income tax. There is, if you come down here, I need to find where it is. Let's see. Tax and credits, let's see. So if you come here to line 23, there is a different schedule and a different form where you calculate the self-employment tax you owe. And it goes here in this amount. And so actually the boxes on that schedule, it's called Schedule SE, and you use this Schedule 2, line 21 to do it. You'll input your income in that, and that income is defined differently. That income is going to include that box 1 of your W-2, plus it's going to include the value of all the housing you've gotten. And so it is the self-employment contributions calculation is a different contribution. It just comes in and gets added to the tax you owe here on your 1040. Okay. So what you put in box 1 is in fact everything that is in box 1 of your W-2. So hopefully that explains how that works. Okay, let's see. Any other questions? And so to clarify there, you don't want to put just your spouse's 10,000 in line 1. You want to put both. It is everything, because you have to pay both income tax and self-employment tax. Okay. All right, let me go back to sharing my screen, and let's talk about some clergy specific things here in our last hour. And it may not take the full hour, but in my experience, nobody complains about. Actually, wait, Kelly, are we till 12:30 or I think 11:30 is the time. But we'll figure it out. We'll go and we'll see, we'll have this adventure together. So the first clergy specific thing I want to talk about is in fact housing. And here's the rule, and we're gonna have this, we're gonna suddenly bring back together U.S. income tax and self-employment contributions. We're gonna bring them all back together because we have to, because the two taxes treat housing differently. All right, the rule for housing, at least as of today, and I say that because occasionally this gets challenged. It is not inconceivable that Congress could change the law related to this. As of today, housing, any income you get as housing, whether cash or in kind, is exempt from income tax, entirely exempt. That's due to section 107 of the tax code. So it's 26 USC section 107, and 107 has two parts. It says that if you provide a house the value of the house to the clergy person is exempt from income tax. And part B, or part 2 of 107, says any amount you pay towards a clergy person's housing, whether it's an allowance, amounts paid for utilities, amounts that even if they get a parsonage, but you pay a little bit more, treat it as housing, that they then use to provide themselves a home, all of that is exempt from income tax. It is not exempt from self-employment contributions. So let me back up and explain first. Let me go back to that concept of adjusted gross income. Remember, I told you that adjusted gross income includes everything unless it is explicitly excluded, okay? And one thing I didn't talk a lot about was it includes everything no matter what form you get the income. So if you are paid US dollars for doing a job, there's a quid pro quo, that's gross income, that's income, that's easy. If you are paid in the US, but you are paid in some other form of currency, let's say, I hope this hasn't happened to you, but let's say you got it in the form of cryptocurrency. That cryptocurrency has a value in US dollars, and whatever the value was when you received it, that's income to you. If you got something else that's not currency related, that's stuff. If you did a job and they gave you a car instead of cash, that car has a value in US dollars, and that's called in-kind income. It is an in-kind payment. It's stuff. That is income. It's gross income. You have to value what you received and report it. Well, for pastors, they get stuff in the way of housing all the time. They sometimes get a house. Sometimes they get furniture. Sometimes clergy get paid, they have their utilities paid on their behalf. Now, Section 107 of the tax code says for US income tax, none of that's income. You don't count it. So it's all excluded. But if we didn't have 107, all of it, including the value of the home that you got for that year, so the rental value for that year would have been income for your US income tax purposes, but for Section 107. And to be even clearer, for self-employment contributions, it is income. So you have to pay that 15.3%. You have to, on Schedule SE and that Schedule 2 that I just pointed to on the 1040, you have to add into the income section the value of the parsonage you got, the rental value, plus any amounts you received as housing allowance, utilities allowance, or any extra amount of housing that you use to support the home, like for snow removal, we'll talk about that. All of that does get reported as income on Schedule SE, and you have to pay self-employment contributions on it. It is subject to SECA. But be clear, if we didn't have Section 107, a clergy person's taxes would be even higher than they already are, because you'd also have to pay income tax on all that value. But thanks to 107, and thanks now to at least one Circuit Court of Appeals in the 7th Circuit, the court system has also upheld this and said, yep, that's okay to give that benefit to clergy. So that's the in a nutshell version of the housing rule. Compensation paid to clergy in the form of housing, whether it's as a parsonage or an allowance, utilities, or extra amount, is exempt from income tax. Now, I get asked this question all the time. What's the difference between a housing allowance and a housing exclusion? There is no difference. The exclusion is the fact that it's excluded from gross income by Section 107 of the tax code. It is simply not income for those purposes. but it only applies to income tax, not self-employment contributions. So what forms of housing income might you get? You might get a parsonage. And let me be clear, it does not matter if the church owns the home or rents the home. If they are providing it to you free of charge and they are paying for it or they own it, it is a parsonage, and the rental value you do have to report for self-employment, but it's exempt from income tax. If you get a housing allowance, if you don't have a parsonage and you either rent or you own your own home and you get a housing allowance, that also is exempt from income tax, not self-employment, but exempt from income tax. If they pay you an allowance for your utilities or they pay the utilities on your behalf, it means you need to ask them, how much did you pay for my light and water bill last year? Not for income tax because it's all exempt, but you do have to report it for self-employment tax because it's all income. Even if they paid the utility company directly, you're getting the benefit of it. And then any amount, we use this language in Missouri. I wish we didn't, and I've seen it in other conferences. I don't know if you do or not. We've long talked, I've tried to change it. We've long talked about a furnishings allowance. This is, so if you have a parsonage in the Missouri Annual Conference, on your clergy support form, you can designate an additional amount of your salary as housing for furnishings. And that also counts as housing in the eyes of the IRS. And we'll talk about what that actually what you can use it for in a minute. Other conferences don't use the language of furnishings. They use the language of additional housing exclusion or additional housing amount. Different conferences call it a different thing. The idea is you're taking some of your otherwise taxable salary, you're treating it as housing so that you don't pay income tax on it, and you use it to then furnish your home with furniture or appliances or other things, okay? Here's the rule. It's exempted or excluded from gross income, regardless of what form it's in, but not self-employment. But you have to use it to pay for housing. The IRS doesn't really care what the conference calls it. The IRS sees it as housing. So the parsonage, the value of the parsonage, that's easy because it's the value of the house you're living in. It's exempted from income, but not self-employment. But if you get a housing allowance, you have to actually spend the allowance on rent, mortgage payments, the utilities, or other furnishings that we'll talk about, okay? That's the general rule, but it's not the only rule, okay? First of all, what furnishings can you spend money on and spend housing money on and it still be exempted from income? Well, I've given you a list in these slides. The one thing I would point, I don't know why the IRS did this, but they say not cleaning services. I don't know why, but they said that. But all these other things, utilities, lawn care, snow removal, small appliances, large appliances, actual furniture, television, rugs, whatever you're doing to furnish your home, you can use housing money for it, okay? However, there are limitations on what you can treat as housing. The first limitation is that the church has to set the amount prospectively. It can't be, it's prospectively. You cannot get to the end of the year and realize, oh, I had a lot more housing expense. I should have treated more of my salary as housing and call a charge conference to set it retrospectively. It's too late. You have to do it at the beginning of the year. And for United Methodists, it's easy. When do we do it? In charge conference. Your church is adopting, I guarantee it, it's part of your support form. They are adopting a housing resolution that says this much is going to be treated as housing, or you get the rent-free use of the parsonage located at 225 San Angelo Drive. That was the address of my last parsonage. I haven't lived there in 10 years, but I still remember it. They have to set it. They have to adopt it. And for United Methodists, that means the charge conference has to vote on it. Okay. So once they have voted on that, can you change it? Sure, but you're going to have to change it in order to deal with expenses going forward. So a change in January or February, you've got plenty of time to spend the money. It's probably okay. But a change in November, December, it's probably too late. You're not going to be able to do it. And you're just going to anger your DS wanting to call a charge conference in November anyway. Okay. An extra charge from last year. They won't like that. So it has to be set by the charge conference. It has to be in a resolution as part of your pastoral support form. Again, I know your treasurer in Louisiana. I know for a fact you all do this. It is part of the charge conference packet that you adopt in your local churches. And don't throw it away. Put it in your tax file so that it's there. You don't have to send it to the IRS, but you will need it if, God forbid, you get audited. And you don't want to have to go hunting around for it. So one limitation is what the church sets. So here's where that comes up. Let's say you're not in a parsonage, you're in a housing allowance, and they say $10,000 for housing. Well, you rent an apartment, and actually it's cheap rent, but it's still $1,000 a month, and you actually spent $12,000 in rent, plus you spent $5,000 in utilities, $17,000. But the allowance amount was only $10,000. Well, the problem with that is that you had $10,000 set. So you can't exclude that additional $7,000. You spent that out of money that's in box 1 of your W-2, and it's all going to be taxed. It's too late. So you have to look ahead to know how much you might spend. Have an idea what your mortgage payment is, your rent payment. If you're in a parsonage, what your utilities might be, what you might need in the way of furnishing, so that you set it in advance and you make sure you have enough. Okay. And the church shouldn't care as long as it's not increasing their bottom line. Don't do this. If you're getting a housing allowance and you're getting, say, $60,000 in cash salary that's taxable, and they want to give you 20 in housing, don't say, no, I need 30 in housing and 60. That you just increase the total. The church will care about that. But if you've got 50 in taxable and 10 in housing, and you say, no, I really need 10 in housing, you can pull from the 50 and if it doesn't increase the amount the church is paying you, they shouldn't care, because it's between you and the IRS. And again, if they act like they care, get your treasurer involved, and your treasurer can help. Okay. The second limitation is your amount you can exclude from income as housing is limited to the rental value of the pastor's home, whether it's a parsonage or an owned home or a rented home. It's limited to the rental value of that home, fully furnished with the utilities paid. So you get extra in that limitation for the utilities and the furniture in it. Okay. I'll talk in a minute about where this one comes into play, but I always get asked the question, well, how do I know the rental value? I don't know. Here's my rule with the IRS: be reasonable. If you live in a really rural area, don't try to treat $60,000 as housing. That's unreasonable. I live in a rural area. I know this. It's unreasonable. If, on the other hand, you live in a suburban or urban area, I'm assuming the rents in New Orleans are like the rents probably worse than the rents in St. Louis and Kansas City. They're high. So you have to be reasonable. Okay. I'll come back to this one to talk about how the limitation might affect you in just a minute. And I see a question that I'll come back to it. So here, the first two limitations. The first limitation is the amount set by the congregation in a charge conference. The second limitation is the rental value of the home. Now, the other thing not to be confused about on rental value, the rental value is also taxable under self-employment contributions. So whatever you set is that you see, you want it high enough to allow an income tax exclusion, but low enough that you don't get killed on your self-employment contributions if you're living in a parsonage. Okay. The third limitation, and I'll come back to the question, is the total amount of housing is that can be exempted is limited to the amount the pastor can substantiate with receipts. You have to actually spend it on housing. So the problem with that is it's not in the moment. The problem arises if you get audited. So let's say you have a housing allowance of $20,000 and you had, $12,000 in rent and you had $5,000 in utilities, and maybe you got the receipts from all those, but then you also bought new furniture, new stuff for the home, and you spent another $3,000, but you didn't save the receipts. If you get audited, the IRS is going to say, okay, the church said it, maybe this is reasonable rental value, but you know what? You don't have receipts to show you spent it on housing. So the $3,000 you don't have receipts for, it's not excluded. You owe taxes on it. So any amount you don't have receipts for, you need to add it. Even if it got excluded from your W-2, you need to add it back into your 1040 as miscellaneous income. Okay. And there's a place for that on the 1040. So I'm going to pause right here, and we're going to spend more time with this because I'm going to give you some examples. So I just had retired clergy call and ask if they can exclude housing if they are retired. I told them no, they only had pension income. Actually, so you gave them wrong advice. So actually, here's what the IRS has said. As long as they were clergy and they retired as clergy, if they are still retired clergy, and here's what they can do. Every year, the annual conference adopts a housing resolution. I guarantee Louisiana does this. Missouri does it. We adopt in conference session a housing resolution that applies to all the retirees. And it says they can exclude up to 100% of any amount they get from their pension or their retirement savings that is held at Westpath. If they've moved it, maybe they can take it, but that's between them and the IRS. Westpath won't guarantee it, and neither will I. But if it's at Westpath, they get it as retirement, they can exclude whatever they spend on housing. They save the receipts. They can exclude that much of their retirement income from Westpath as housing. And the beauty in retirement is not only can they exclude all that as housing if they spent it, but they very quickly don't pay self-employment contributions anymore. So they have a large chunk of income that is now entirely tax-free. That is a great benefit for retirees. And here's the IRS's reasoning. If it is paid through a church retirement plan, it's really just deferred income that they would have gotten when they were actively working as clergy. And so if they get it while they're retired as clergy, they can still get the housing benefit. So hopefully that makes sense. That was a great question. Comes up a lot, and retirees do get a housing benefit, even if they're only getting their income from Westpath now. Okay. Now let me talk. Perfect. So GBGM, I don't know what GBGM is doing. I think, and I don't know if this person asking, maybe here's the deal. If you are retired from GBGM, it's them doing it. But if you're retired as a clergy member of an annual conference, it's your annual conference that needs to do it. And for most, that's the way it'll work. And I think every annual conference in the United States does this. I can't fathom one that doesn't. Okay, let me talk a little bit about how these limitations work. Let me go back a slide. All right. Maybe I have a summary slide. Yeah, here's a summary of the 3 limitations. So let's talk about this, and I'll give you some examples to show you how it works. Let's say that the church, I've already given you a few, but let's say the church, let's say you start a new church and you start it in a rural area. I live in a place called Moberly, Missouri. It's got about 14,000 people, but right outside of town, there are communities where there's like 400 people. And let's say I start a new church in one of those communities, and boy, it really takes off. In fact, it takes off, and it's nobody can understand it because it's just the work of the Holy Spirit. And I have all of a sudden 3,000 people in a church, and it becomes, for United Methodist standards, kind of a mega church, a big church. And I'm the founding pastor, and I've done this all in just a few years. And the church is just, the leadership is ecstatic, the conference is ecstatic, and they want to give me a huge paycheck. Let's say it's $100,000 cash salary paycheck. And on top of that, they say, you know what? We want to take care of you. We're going to give you $75,000 of housing that you can spend on housing. Okay. And the charge conference votes to approve $75,000 housing allowance. I'm ecstatic. Can't be happier. However, I live in Moberly, Missouri. And quite honestly, I live in a modest house, not a mansion, just a house. And that house, I don't know what the rental value is exactly, but here's what I can tell you. In Moberly, Missouri, it's possible to rent a 2-bedroom apartment for $500 a month. Now, my house has 4 bedrooms and 3 baths. Again, modest, but nice. It's somewhere more than that. But is it $75,000 a year nice in a rural place in Missouri? Absolutely not. Maybe counting the utilities, knowing what I pay for my mortgage, counting the utilities, and counting like a heck of a lot of work around the house and additional furnishings every year, I'm thinking maximum $30,000 a year. That is unreasonable to set that high of housing. They can give me the income. That's great. But they shouldn't make it all housing. I need to pay taxes on $45,000 of that. The other thing, if you live in a rural place, and especially if, I mean, I actually don't spend that much every year. I'm an old lawyer who knows how to save $1, and I'm not great at spending $1. I don't spend very much on furnishings. There is no way I could have receipts, even if I were lavish, of $75,000 a year in housing costs in rural Missouri. It's not possible. In some places it might be possible, but not where I live. So you see how those limitations, they all apply, and you have to ask each one, did the congregation set the amount that I'm excluding as income? What is my fair rental value? You don't have to have an exact number. Nowhere is it going to ask for an exact number, except to calculate your self-employment contributions if you have a parsonage. But you just have to have an idea and stay below that, be reasonable. And then you have to actually spend the money on housing in order to take advantage of this housing benefit. Okay? Let me pause there and see if there are any questions. Take us out of sharing. Okay. All right. Let's go back to sharing. So now, oh, I see a question pop in the chat. I will give one moment. Somebody's going to ask a question, I think. That's okay. See, so here's the question. The number, let's say it's 30,000, but we only report 20,000. Is that okay? So, and by that, I think what you mean is the housing, the total housing allowance you're getting is 30,000, but you only report 20. So the short answer is yes. However, it's a little more complicated because here's the deal. You're not going to actively report this unless you have to, because you don't report the exclusion. The exclusion simply applies. And so the church gives you $30,000 in housing. It never appears on your W-2 unless they put it down in that box 14 miscellaneous block I showed you when we talked about the W-2. And most churches don't do that. So that you never see it. You just have to know I'm also getting an additional $30,000 in housing. If you only spend 20 of it, no problem. But you're not reporting 20 on your 1040. You're saying I have 10,000 extra of taxable income that I didn't spend. And you put that in there's a line, it's pretty obvious on the 1040 called miscellaneous income. You report that 10,000 in that line. And so you add it back into your income when you calculate your income taxes on your tax return. But the idea that you can set a housing allowance higher than what you actually spend, that's fine. And the church shouldn't care as long as you report what you don't spend as income. Hopefully that makes sense. You got it. Because then the follow-up question was because you're paying taxes on the 10,000, right? Yes, that's exactly right. You have to pay taxes on what you didn't spend. You got it. All right. Other questions on housing before I move us to something else? Okay, let's talk about professional expenses. Professional expenses. First of all, let me say at the outset, several years ago, in 2017, this was a change made to the tax code, and a lot of United Methodist clergy thought this was really bad for them. I disagree. I think it's indifferent for us as United Methodist clergy. It used to be that if you were a pastor and you spent money for the local church, and you weren't reimbursed for it, you could deduct it from your income taxes. Now, there was a floor to that. You had to get over, I think it was 2% of your adjusted gross income that you had to spend in order to take the deduction. You had to be able to substantiate it all. But yeah, it's true. You could deduct it. However, it wasn't actually a deduction for self-employment. So you ended up paying SECA on that money that you spent for your local church. And I always said, don't do that. Don't that deduction's worthless. Instead, give it to, back then you could, still most clergy were itemizing. I always told clergy, give it as a contribution to the local church and take it as a deduction rather than this as a charitable deduction, rather than as this weird professional expense deduction where you're never going to get, you may not get to the floor that's required. But worse than that, you had to pay this self-employment on it, and that didn't seem right. Well, Congress, in passing tax reform, had to find a whole bunch of tax savings, and they realized they could squeeze out some savings to the government if they eliminated some deductions, and that was one of the deductions that got eliminated. So today, if you spend money on behalf of your local church and you don't get reimbursed, sorry, there's no deduction. It doesn't exist. But there's always been a better way, and the better way still exists today. It's called an accountable reimbursement plan. And here's the idea. You spend money on behalf of the local church, and the church recognizes that, and you give a receipt for what you spent and the reason, and the church reimburses you. And assuming you have an accountable reimbursement plan in place, the reimbursement is entirely tax-free because it's not your income. You spent the money on behalf of the local church. So you can get reimbursed for the expense and not pay taxes on it because it's not income. It was an expense of the local church, which is otherwise tax exempt anyway. So there's no tax at all. Now, here's where it gets tricky. A lot of, and this happens in Missouri, and I suspect it happens in other annual conferences, and sometimes district superintendents play a role in causing a problem. You're going into a new appointment, and you've got a pastoral support form. And on that support, I don't know what the support form looks like in Louisiana, but most of the time you've got your salary and you've got your housing. And sometimes it's even accounts for your like health benefits, how much you're getting for that, and how much the church is contributing to CRSP, your pension. And then there's also a section that talks about, because the local church only thinks of one thing, and that is the total expense that it's going to have to pay for a pastor. There will be a section on professional expense and continuing ed. Those expenses, and that amount is really a budget for the local church for its accountable reimbursement policy. But make no mistake, it's not compensation to you as a pastor. Here's what can happen. You can say, well, wait, the church is only budgeting $2,000 for professional expenses. I might spend that much just traveling to annual conference and getting a hotel room. And certainly if I do any other kind of continuing ed, I may spend it all. Like, and I may not, then they won't reimburse me anymore. And now I'm out. And so DS, I need help. I need more in professional expenses. And the DS says, sure, don't worry. You're way above minimum comp. You're at $55,000. We'll just pull another $3,000 out of your comp and put it in professional expenses. You just took a pay cut. You just gave the church $3,000, and they're still going to expect you to tithe on what you make, because it's money you're spending on behalf of the local church. That's the key concept. It is not compensation for you, and that's why it's not taxable. The church has to adopt an accountable reimbursement policy. And if it does, it can reimburse, and we do this in Missouri as part of the charge conference packet. I'm guessing you do the same thing in Louisiana. You account for your expenses that you spend on behalf of the church, you get reimbursed, and there's no tax whatsoever. It never gets reported anywhere. You just got reimbursed for a professional expense or for continuing ed. But it's money you're spending on behalf of the local church, and that's key. It's got to be business related. It cannot be for a personal benefit. It has to be for a benefit to the local church. Even continuing ed, as a pastor with my staff, I had a staff, including some appointed clergy, and now in the annual conference, I take a really expansive view of continuing ed. I think a lot of different education events can benefit the local church. You want to go to a writing conference? Go to a writing conference. That will help you as a pastor. You want to go to a conference about ministry? Of course, it's going to benefit the local church. But there are some things that may be over the line, maybe, I don't know, underwater basket weaving. I don't know. That said, I take an expansive view, but you have to not squint your eyes and see that there's a business purpose. It's got to be related to the local church. No personal use. If they reimburse you for, I don't know, a car, a meal, that meal had to have a business purpose. You can't go to lunch by yourself and say, I'm doing the work of the church and get reimbursed. The IRS will say, absolutely not. And you're not just putting yourself at risk. So some things like housing, I let clergy make bad decisions because it's their risk, not the local churches. With this, it's the church's risk. There is this thing, and I'm going to talk a lot more about it in the afternoon session, called private inurement. If a church allows one of its insiders, and especially a leader like a pastor, to personally benefit from the income to the church, from the church's assets, that is a violation of the tax code, and it can result in a loss of tax exempt status for the local church. This is why, and I suspect I've got some church business administrators on even in this session, but pastors who are on, if you've got a church business administrator who's losing his or her mind because you're not turning in a receipt and wanting reimbursement, this is why. The church is at risk. It could be private inurement. It looks, and for you, you're at risk too, because it looks like tax evasion. No personal use. You can, however, say, I'm taking the church council chair to lunch and we're going to plan the church council meeting. That's got a business purpose. You can say, I had to travel to annual conference and purchase all my meals in a restaurant, whereas otherwise I would have brought food from home. Now you've got a business purpose for the meals, all reimbursable. But here's another key. If you buy a thing, a computer, a printer, and you get reimbursed for it, to whom does it belong? It's a business purpose. It can only belong to the local church. And that comes up because we, as United, especially elders, we are itinerant. Every year in June, July, I get the question, Pastor so-and-so is moving, bought a computer, got reimbursed, bought a computer in March, got reimbursed, and now wants to take the computer with him or her. Can they do that? The answer is no. And if the church lets them do that, they can let them do that, but the value of the computer needs to be reported in box 1 of the W-2 because it's now income. You can't give a gift, even to a departing employee. It's all income. You can only give a bonus. Books, they belong to the church, not the pastor. Now I'll say books, as somebody who wrote a book and has found his book in a used bookstore, I can tell you that the value of a book goes from something to nothing faster than a car. Published a book in 2017, found it in a used bookstore in 2018, retailed for $17. In the used bookstore, they were charging 25 cents. A church probably is going to be just fine and may even want to say, send a letter as you depart the church. We know we reimbursed you so much for books over the course of the last 4 years. We are giving you the books and determine their value to be zero, meaning there is no tax to you. But the books still belong to the local church, not you, unless they give them to you. And if they say, yeah, we want to keep those for our library, sorry, you got to leave them. Buy the books with your own money if you want them to be yours. You see books on my bookcase back here. Some of those have been bought with professional expenses. I have a stamp with my name. I stamp the books that I bought with my personal money. And I don't stamp the ones that need to stay. So that there aren't that many on that bookcase. I kind of know what I need to leave when I depart. Okay. I see a question. I'm going to answer that. Lunches, golf, clubs with members, or other clergy, are the church expenses, or is it up to the church? Yeah. So in some ways, it's up to the church. The church has to decide, is this a benefit to us? And if they think no, they don't have to fund it. It can be, it can be. And we have a couple of suburban, not huge, but larger churches here in Missouri in well-to-do communities. And they actually keep a membership at the local country club that is for the purpose of the pastor. Now, I caution them, and they know this, and that they've got pretty sophisticated folks, that the pastor can't be, I mean, there's a concept that the IRS has called de minimis benefit, which means minimal. They can have a minimal benefit for the pastor and his or her family. So maybe they take the family to the country club, once or twice a year. That's fine. Maybe especially if they still have to pay for the meal, they can take their family to lunch at the country club and pay for the meal out of their own pocket. That's probably fine. But generally that club membership has to be used for church purposes. So members, or prospective members, or if you're trying to solicit a large gift from somebody who's on the edge of church attendance and membership, sure, all church purpose. But it does, I mean, it on the one hand, it's up to the church, but on the other hand, the church can't collude with you to give you this significant personal benefit and not then report it to you as taxable. Hopefully that makes sense. Let's get back to there. Let me talk about mileage, because mileage is really just part of the professional expense package. It is part of the accountable reimbursement policy. Here's the idea. If you are driving your personal vehicle for church business, to do a hospital visit, to do a home visit, they want you doing that. That is for the benefit of the local church and its membership. And the mileage you drive can be reimbursed. And every year the IRS sets a rate for the mileage. And so for it actually has gone up a little bit more for 23. For 22, it was at 62.5 cents a mile. And they increased it mid-year because of inflation. It's never happened in my time in ministry. But you have to be driving the car for church business. And the idea is that reimbursement, that even at 62.5 cents, that's more than gas costs right now. Even at $3.50 a gallon, it's still more than gas. But at least, I mean, unless you're driving a real gas guzzler, it's still more. The idea is it's covering the gas and the cost of wear and tear on your vehicle, because you are now putting your personal vehicle that you bought with your money into the employment of the local church to do the church's business, and the church ought to reimburse you for that. There is a rule that says no commuting miles. Every American has to commute. And so, sorry, you don't get commuting miles. That gets complicated with United Methodist Clergy, because the question is, what's the commute? Especially when there's a 2 or 3 point charge. Now, let's say you just have one church. And let's say the parsonage is next door to the church, and your commute is 30 feet. No problem. You don't get mileage for the commute anyway. You then leave the church or your home driveway and you drive to the hospital all the miles. Because you live next door to the church, it's easy. All the miles you drive on behalf of the church are reimbursable. But now, let's say it's one church, but you're part-time, and really you're just there 2 or 3 days a week, maybe 1 day a week, and then Sundays. And I have this in Missouri. We got a couple of folks, really, really committed and generous licensed local pastors, and they live 100 miles from their church. They cannot get reimbursed the 100-mile drive from home to church. It's commute. It doesn't matter how long it is. Now you may say, wait, I heard there's a home office exception. That's true. However, it's the same rule. The home office has to be for the benefit of the church, not you. Just because you have a 100-mile commute is not grounds to have a home office. I got called by a pastor a few years ago who said that there's one guy, the church wants to reimburse me for my drive. It's a 55-mile drive from my house to the church. They won't reimburse me for that. And I said, they're right. That one guy is objecting, saying we can't reimburse him. The rest of the church wants me to be reimbursed. And I say, they're right. They can pay you, but it's taxable. It's not a reimbursement. And he said, but I have a home office. And I said, no, sorry, it's got to be for the benefit of the church. And the pastor stopped me and said, you don't understand. The church has one room, the sanctuary. There's no office. And more than that, there's no indoor plumbing. They have an outhouse. And more than that, they want to reimburse me. They want me to have my office at home because they don't want to pay the light bill for me to be in the church more than once a week. And I said, I take everything back. You have a home office. You can be reimbursed for your drive from your home office to your local church. But that's the idea. That church, it benefited them to have their pastor officing at home. Now, in the days post-COVID, this has gotten really murky. When is it for the benefit of the employer? And when it's hard. Again, my rule for you is be reasonable. So in the conference office, I've got a few remote employees, including the DSs. They live and work in their district. And I've got job descriptions for those remote employees. If they ask to be remote, sorry, they don't get commuting mileage. But if, like our DSs and a couple of others who are regionally situated and we need them in those spaces, they can get commuting miles. It's in their job description that says it's for our benefit that they're living in this location. Okay. The same is going to apply at the local church level. you're not going to get a commute unless your church can't have an office for some reason or doesn't want you in the office for some reason. The other issue that comes up for United Methodist clergy is the 2 or 3 point charge. So let's say you live 10 miles from your first church, and then it's another 10 miles to your second church. The drive from home to first church is a commute, not reimbursable. But as soon as you're in the church, you're now on church business, and the drive from church 1 to church 2, now it's reimbursable because you're not commuting anymore. You're driving between the 2 churches. Now I get asked all this all the time. What if it's shorter for me just to drive the drive back from 2 to 1? That's reimbursable. What if I live close between the 2? Be reasonable. Ask to be reimbursed for the lower amount. Cut what would be a commute entirely out of the reimbursement. That's the general rule. Okay. If the hospital is on the other side of your home from the church and you drive to the hospital, subtract out the commute, and then you just go straight home, subtract out the commuting miles. However, if you're outside the ordinary course of the church's business, if you're traveling for the church on your day off or for on a Saturday, that now could be reimbursable. Now, if the church has business hours on Saturday, sorry, you're back to a commute. But you get the idea. If the mileage is for the benefit of the church and not you personally, it's reimbursable. I'm going to stop here, and we're almost to the end of time and to the end of this presentation. I have a book. I published a book a few years ago. I'm going to be honest with you. It's a little dated. It came out right before tax reform, but the general concepts all are the same. And all this material that I've covered today is in the book. It went out of print, but God love it, one annual conference asked to give it to their entire RIM group, and United Methodist Publishing put it back into print. So it is back in print. It's available from Cokesbury, available from Amazon, available even from Target and other retailers. And it covers more than taxes. It covers a host of topics, both for individual finance for clergy and for congregational finance and administration. So I just want to raise that to you. So I'm going to stop here, see if there are any questions. And then I think, and Kelly, you tell me if I'm wrong, but I think we are to our break. I don't see any questions. All right, would you all do this? Would you let me pray for you guys for us to, oh, maybe I do have a question. Somebody's using my book. Perfect. I am through Dakota Wesleyan, my friends at Dakota Wesleyan. I am thrilled that you are doing that. Well, let me offer a prayer for you guys, and we will stop here. Let's pray. Gracious God, we give you thanks for the morning, give you thanks for each of these individuals and their ministries, their local churches, their colleagues. And I pray that they take what they have learned today and are able to step into the future. God, I pray for your church, the United Methodist Church, even in its current struggles, that you bring us out into a place of peace, and a place of great fruitfulness and good ministry. God, I pray you be with us. Bless the food that we eat for lunch and the hands that prepared it. Be with us as we go forward into the week ahead. Be with those who return for the afternoon session. And we pray all these things in the name of Christ. Amen. All right. Well, thank you guys so much for your attention this morning. And maybe I'll see some of you back this afternoon.
Thank you, Nate.
And Chris, I don't know if you have any concluding remarks.
Yeah, I'll just jump in real quick. Thank you, Nate. So if you are interested in registering for session 2, that's a tax seminar for church staff. It will start at noon. You will need to register and log in separately for that. Just go to our website, www.umf.org. Look on the homepage for session 2 button to register if you haven't already. And if you have registered, you'll have an email in your inbox with the join meeting link. And so we'll adjourn now and start up again at noon. Nate, thanks so much for your time. Go rest your vocal cords and get a little sustenance, and we'll join back here in about 30 minutes or so. Thanks
Thank
all.
you,
Hope this has
Nate.
been helpful.
Thanks, everyone.